everyone. Today, let's start a new chapter, bonds and bonds valuation. In this chapter, we have the following topics that we need to study. Number one, the key features of bonds. Number two, the valuation of bonds. Number three, the property of bonds. And then number four, yield to call versus yield to maturity. The first topic is the key features of bonds. And before we go over these key features, let's ask one question. What is a bond? So, a bond is a long-term debt instrument that the borrowers promise to pay the lenders both the principal and the interest on specific dates. Not any debt instrument can be called a bond. Okay, so not any loan, not any IOU can be called a bond. So if I borrow $10,000 from you, I write a note, make a promise that I'll pay you back the principal plus 10% interest, 1 year from now. Okay, that's not a bond. Okay, that is a debt instrument. That is a loan or that is an IOU, but it cannot be called a bond. Okay. A bond must be a long-term debt instrument, okay, with all the principal and interest payment standardized. And the standardization is very important, okay, because without a standardization, then this debt instrument is not tradable. And when it's not tradable, it cannot be called a bond. Only after we standardize all the principal and interest payments, and this debt instrument can be tradable, and then it can be called a bond. Okay, so standardization, that's very important for bond. Okay, now who issue bonds? Bonds can be issued by governments. Okay. Federal government, state governments, local governments, okay, they all can issue bonds, okay, and bonds can also be issued by corporations, okay, so companies who wanted to borrow money, okay, they can also issue bonds. And all bonds are traded on the over-the-counter market, okay, and most of the bond trading is among financial institutions, not among individual investors. Now, let's look at some of the key terminologies of bonds. So these are the key terminologies that we find in any bond. So face value, which is the denomination of the bond, the coupon interest rate, and the maturity of the bond, and lastly, yield to maturity of a bond, which is not directly found but can be calculated. Okay, now let's look at these key terminologies one by one. So face value, what is a face value? And some people also call it par value. Okay, so face value, par value, they mean the same thing. Okay, so face value or par value is the last cash flow that the issuer of the bond will pay you at the bond's maturity. Okay, so face value or par value is the last cash flow that you as an investor or the lender are going to receive from the issuer of the bond, okay, at the bond's maturity. Okay, so in general, the corporate bonds are mostly issued at $1,000 face value. So in this class, unless it's stated otherwise, you can always assume that the face value of a bond is going to be $1,000. Okay, and in reality, most of the corporate bonds, they do have a face value or par value as 1,000. Okay, that face value 1,000 means that at the maturity of the bond, the last cash flow you're going to receive is $1,000. Okay, it does not mean that the bond is currently selling at 1,000. Okay, face value or par value is not the price of the bond. The market price of the bond are generally represented by a percentage of the face value. So for example, if the market quote of the bond price is 110 on today's Wall Street Journal, that means if you want to buy the bond, you have to pay 110% of the bond face value today. So if the bond face value, for example, is 1,000, then you will have to pay $1,100 to buy the bond today. Okay, and at the maturity of the bond, the issuer of the bond will pay you the face value $1,000, regardless what price you pay for the bond. And some people might ask, why do I have to pay $1,100 for a bond that gave me a last cash flow as $1,000? Well, besides the last cash flow, besides the face value, the bond also pay you interest payments. We call it coupon payments. Okay. So the coupon payments needs to be calculated by using the coupon interest rate, which is a percentage of the face value. So when you observe a coupon interest rate, you multiply the coupon interest rate by the face value to get the coupon payments. Okay. So for example, if the bond face value is 1,000, the coupon interest rate is 10%, then the coupon payments is 10% of 1,000. So that'll be $100. What does that mean? Well, this bond will pay you $100 as the coupon payment every year for the length of its maturity. And then also at the end of its maturity, the bond will also pay you the face value 1,000 as the last cash flow. So over the years, you receive a series of $100 coupon payment plus last $1,000 face value as the last payment. Okay, and this is why some people might want to pay a premium or higher than the face value to buy the bond. Okay, because he's not going to receive just the face value, but also the coupon payments over the years. Now, sometimes the bond are semi-annual bonds. So if the bond is semi-annual, then that means the issuer of the bond will pay the investor on a half-year basis. So use one example. Let's say the coupon rate is 10%, but it is a semi-annual bond. So that 10% is the nominal yearly coupon rate. Okay, but the bond issuer pays investor on a semi-annual basis. What does that mean? That means every 6 months, as the investor of the bond, you're going to receive $50 as the coupon payment. Okay, until the bond matures. And when the bond matures, at its maturity, you also get the face value or the $1,000 face value back as the last cash flow. Maturity is the length of time that before the bonds is matured or before the bond life is ended. Okay, so maturity is determined by 2 dates: the issuing dates, okay, when the bond was issued, and the maturity date when the bond matures. Okay, so the length of the time between those 2 dates is maturity, and maturity can vary. Sometimes it can be as long as 30 years. Sometimes it can be as short as less than a year. Now, yield to maturity is the rate of return that an investor of the bond can expect from investing or buying the bond. Okay? So when you buy the bond and hold the bond till its maturity without selling it before the maturity, then you can expect to earn the yield to maturity as a rate of return for your investment. Okay, and the yield to maturity is never directly given. It has to be calculated by using both the cash flow of the bonds, including coupon payments and the face value, and also the market price of the bond. So by combining these values, we can calculate the yield to maturity. Nowadays, most of the corporate bonds are callable bonds. And callable or call provision means that before the bond matures, if the bond is callable, then the issuer has the right to buy back the bond from the investor at the predetermined price. Okay, so if the bond is callable, that means the issuer of the bond can buy this bond back from the investor before the bond is mature. Okay, normally the issuer of the bond or the company that issues the bond will execute the callable feature when the interest rate declines. Okay, so that they can buy back their bonds at a predetermined price and issue some new bonds with a lower interest rate to replace those bonds that carried a high interest rate. So when the interest rate declines, then these issuing company that issues those bonds can call back those bonds or execute the callable feature, means buy back those bonds from the investor and replace them with a lower interest bond. And for the bond, if it's callable, then the investors dislike it. The issuing companies do prefer that. So compared to a non-callable bond, a callable bond must offer a higher interest rate to be able to make it attractive. Otherwise, because it's callable, then the investor might prefer to buy the non-callable bonds. And most of the callable bonds have deferred call feature, which means in the first couple of years after the company issued the bond is not callable. And then only after a few years, then the bond becomes callable. So for the first couple of years, the bond is protected from being called. And that's a measure to attract the investor to the bond. Okay. So deferred call, that's what it's called. Okay. And also, most of the callable bonds have a declining call premium. That means the predetermined price that the company can call the bond decreases as the time getting closer to the maturity of the bond. Okay, so when it's closer to the maturity, then the call premium is lower. Some of the corporate bonds now have the sinking fund feature. Sinking fund feature means the issuer of the bond can pay off the bond's interest plus principal over the time. So you can look at the bond with a sinking fund feature as amortized loan. So the borrower will pay off not just the interest over the years, but also some of the principal. Then in that case, the issuer doesn't have to pay a huge lump sum payment at its maturity because it pays off the principal gradually over the years. Okay, so if a bond has a sinking fund feature, that means the bond issuer made a promise to gradually reduce the level of their debt, which is good for the investor of the bond. But now, the sinking fund feature might not be a good thing for investors if the interest rate declines after the bond was issued. Then some of the investors might run into a reinvestment risk because their investment in the bond is returned. And now they have to reinvest that money into some lower interest rate that instrument because interest rate is lower after that bond is issued. So that might not be a good thing for some of the investors because of the reinvestment risk. Sinking fund feature can be executed in two ways. The first one is the company run a lottery, and those who get picked will have to sell the bonds back to the issuing company at its par value. So this is what the company will do if the bond price is currently higher than its par value, because the bond issuing company can buy them back at the par value when the market price is higher than the par value. So that's what a company wants to do because that will save them some money. So when the bond is selling at a premium, means a price higher than its par value, then normally the issuing company will choose to execute the sinking fund feature by calling back the bond as par value. Another way the bond can execute its sinking fund feature is to buy back the bond in the open market. And normally the company will do this only when the market price of the bond is lower than its par value. So the company doesn't have to spend the par value to buy back the bond. Actually, they will spend less than that to buy back the bond if the bond is selling at a discount or a price lower than the par value. So these are the two major ways that a company will execute its sinking fund feature. Now, our second topic in this chapter is bond valuation or pricing of the bond. So the bond valuation is similar to a valuation of any financial asset. Now, how do we value a financial asset? A financial asset has to be an asset that's going to bring in cash flows in the future. So to value a financial asset, we'll have to look at the cash flows that the financial asset is going to generate in the future. If somehow we can calculate the present values of these future cash flows by adding these present values together, then we should get to the intrinsic value of the financial asset. So bond is similar. Now, for a bond, what are the future cash flows that we can expect from a bond? A bond will pay coupon payments over the years, and also at its maturity, the bond will pay the face value as the last cash flow. So the cash flows we can expect from investing in a bond are the coupon payments and the face value. So if we can calculate the present values of these future cash flows, and we can get the intrinsic value for bond. Now, to get the present value, we have to discount the cash flows which will happen in the future. Now, what will be the discount rate? The cash flows themselves are not too hard to calculate because if you know the face value, you know the coupon rate, you know pretty much what the cash flows are going to be, right? The coupon payments, you can just calculate that by using the coupon rate times the face value. And the face value itself is also a cash flow. So these are fixed, and that's why we also call bonds fixed income. Now, how do we calculate the present values of these cash flows which will happen in the future? Well, we have to figure out the proper rate, discount rate to calculate the present values. Now, what will be a proper rate, discount rate? Well, it will be yield to maturity of the bond. So for any nominal interest rate, the components of the nominal interest rates are the real risk-free rate and the inflation premium and the default risk premium and the maturity risk premium and the liquidity risk premium. So either some of these or all of these components depends on what type of risk that the security has. So for bonds, if it's a treasury bond, then we don't have to worry about default risk. We don't have to worry about liquidity risk. So in that case, the nominal interest rate or the yield to maturity of the bond is only the real risk-free rate plus inflation premium plus maturity risk premium. If it's corporate bonds, then we have all of these different components as a risk factor. Then the nominal interest rate should include the premiums for all these risk factors. Now, let's look at an example of pricing a bond. So suppose we have a 10-year bond, the coupon rate is 10%, and then the bond is annual bond. If the yield to maturity is 10%, so based on the risk factors of the bond, then we calculate the yield to maturity as 10%, then what should be the intrinsic value of the bond? Well, if the bond has a 10% coupon rate, and by default the bond face value is 1,000, that means the bond's coupon payments are 10% times 1,000 face value. That will give us $100 as the coupon payment. And the bond has a 10-year maturity and it's an annual bond, so that means the investor of the bond is going to receive $100 every year as the coupon payment for 10 years. So in total, there will be 10 of these $100 coupon payments. And also at its maturity, the investor will also receive the face value back, which is 1,000. So if you draw a timeline, there will be 11 cash flows on the timeline. There will be 10 of the $100 coupon payments as the 10 cash flows, and also the last cash flow, $1,000, which is the face value. That's the last cash flow that the investor is going to receive. Okay. So now, all these cash flows are future cash flows, so they're future values. Well, we'll have to calculate the present value. Now, if we know the yield to maturity is 10%, then what will be the present values of these future cash flows? Well, the first $100 coupon payments, we're going to receive that 1 year from now. And then to find its present value, we have to use the generalized formula 100, which is the future value, divided by 1 plus the discount rate, 10%. And that way, we get the present value of the first $100 coupon payment. And you do the same for every one of these coupon payments by discounting the $100 coupon payments at 10% for different number of years. And there will be 10 of them. And also, at the maturity, we're going to receive that $1,000 face value. So that is also a future value. We will have to convert it to a present value. Now, this future value will happen 10 years from now. So this $1,000 face value is a cash flow that happens 10 years from now. So its present value will be 1,000 divided by 1 plus 10%, the discount rate, raise that to the power of 10. So discounted for 10 years at 10%. And that should give us $385.54. And all the $100 coupon payments before the face value, they will have to be discounted as we discussed above. So once we find all the present values, add them up, and that will give us the intrinsic value of this bond. And in this case, it turns out to be $1,000, same as its face value. And this is not just a coincidence. It's because the coupon rate, which is 10%, equals the yield to maturity, which is also 10%. So when you have a coupon rate equals the yield to maturity, then your bond's market price will be the same as its face value. And in this case, we find that the intrinsic value or the market price of the bond is 1,000, same as its face value. And this is what we call a par bond. So the price of the bond is the same as its face value. We call it a par bond. Now, we can use a financial calculator or an Excel spreadsheet to do the same calculation. By using a financial calculator, you will have to give a value of 10 to n because the bond maturity is 10 years. And then you have to give 10% as the IY because the yield to maturity is 10%. And here we ignore the percentage. The future value will be 1,000 and the payment will be 100. And notice here the future value and the payment both carry the same sign. Both are positive. And this is because both the coupon payments and the face values are the cash flows with the same direction. So their signs should be the same. In this case, I entered them as a positive number. Okay, so 1,000 for future value, 100 for payment. Then we can calculate or compute CPT, the present value, PV. And that should give us $1,000 as the present value. Now, in the Excel spreadsheet, type in equal and then present value, PV, and then the values for these parameters are 10% or 0.1 as the interest rate or yield to maturity, 10 as the maturity, 100 as payments, and then 1,000 as the future value. And don't forget to use comma to separate these values. Then close out the parentheses, press Enter key. You should get the $1,000 intrinsic value as well. Now, let's change our example a little bit. So, what if the bond pays a 12% coupon rate instead of 10% coupon rate, and everything else remains the same? So, for example, the maturity remains at 10 years, and then the yield to maturity remains at 10%. Well, in this case, if the coupon rate is 12%, then multiply 12% by its face value 1,000, we get a 120 as the coupon payment. So every year, the investor of the bond will receive $120 instead of 100 as the coupon payments. And there will be 10 of them. And also at its maturity, the last cash flow will be 1,000, which is the face value. Okay. Now, how do we calculate the intrinsic value of the bond? Every cash flow will have to be discounted to find its present value. So the first $120 coupon payment discounted 10% for 1 year. So divided by 1 plus 10%. And then the second $120 will be divided by 1 plus 10%, reset to the power of 2. So there will be 10 of these present values calculation. And also the face value 1,000 will have to be discounted at 10% for 10 years. So divided by 1 plus 10%, reset to the power of 10. And then as a result, you should get the intrinsic value of the bond as $1,122.89. And notice here, the bond's intrinsic value or market price is higher than its face value. So $1,122.89 is definitely higher than par value 1,000. And this is what we call a premium bond because the bond is selling at a premium price. And we only have premium bond when the coupon rate is higher than the yield to maturity. And in this case, the coupon rate is 12%, the yield to maturity is 10%. So the coupon rate is higher than the yield to maturity. And then we have a premium bond. We can also use a financial calculator or Excel spreadsheet to do the same calculation by using a financial calculator. 10 for maturity, 10% for yield to maturity, 1,000 for future value, 120 for payments, both are positive. Then compute present value, you should get the same number, $1,122.89. In the Excel spreadsheet, equal sign, PV as present value, in the parentheses, 0.1, 10% as interest rate, or yield to maturity, use comma, and then 10 as maturity, comma, 120 as coupon payment, comma, 1,000 as future value. Then close the parentheses, press enter key, you should get the same answer, $1,122.89. Now, let's change the example a little bit. So instead of 10-year 10% coupon rate, we have a 10-year bond with 8% coupon rate. Now, if the yield to maturity is 10%, what should be the intrinsic value or market price of the bond? Well, in this case, with 8% coupon rate, your coupon payment will be 8% times the face value 1,000, that would be $80. So these $80 are future values. We have to convert them into present values. The first $80 coupon payment divided by 1 plus 10%. The second $80 coupon payments will be divided by 1 plus 10%, raise that to the power of 2. And then the last cash flow, the face value 1,000 will be divided by 1 plus 10%, raise that to the power of 2 because it's a future value at the end of year 10. Now, with all these present value calculated, add them up, we get the intrinsic value of the bond, $877.11. Use financial calculator or Excel spreadsheet, you can get the same answer. By using the financial calculator, 10 for maturity and 10% for yield to maturity, 100 as future value, 80 as payment, and then compute present value. So that should give you $877.11 as well. In the Excel spreadsheet, put equal sign and then PV, that stands for present value, in the parentheses, 0.1 or 10% as yield to maturity, comma, 10 as maturity, comma, 80 as coupon payments, comma, and then 1,000 as the future value, and then close the parentheses, press enter key, you should get the same number, 877.11. And notice here, we have a bond that currently selling at $877.11, which is lower than its par value. And this is called a discount bond. Now, when is a bond a discount bond? Well, when your coupon rate, in this case 8%, is lower than the yield to maturity, so 8% is lower than 10%, then you will have a bond that will sell at a price lower than its par value. So that bond will be a discount bond. Let's study our next topic in this chapter, bond properties. So our early examples show that bond sometimes can be a premium bond, means the price will be higher than its par value. And sometimes the bond price can be lower than the par value. We call it discount bond. And sometimes the bond price can be equal to the par value, which we call it a par bond. Okay. Now, under what circumstances a bond is a premium bond or a par bond or a discount bond? Well, when the coupon rate is higher than the yield to maturity, we will have a premium bond. That means the bond price will be higher than its par value. When the coupon rate equals its yield to maturity, then we will have a par bond. Means bond price will be the same as its par value. Now, when the coupon rate is lower than the yield to maturity, we will have a discount bond. The bond price will be lower than this par value. Now, the next graph illustrates what will happen to the premium bond price or the par bond price or the discount bond price over the time if we hold the yield to maturity constant. Well, regardless of the bond current price, it can be premium, it can be par bond, it can be a discount bond. Think at its maturity, what will be the bond price? Well, at its maturity, regardless of its current price, all the bond price should be the same as its last cash flow, which is the par value. So at their maturity, the bond's price should always be 1,000, the par value. Now, premium bond means currently the bond sells at a price higher than par value. Now, if we hold the yield to maturity constant, what will happen to the premium bond price? Now it's selling at a premium at its maturity, albeit its par value. So over the time, the premium bond price must be decreasing. So that means if we hold the yield to maturity constant, the premium bond price will decrease over the time. Eventually, it will converge to its par value. Par bond, if we hold the yield to maturity constant, its price is going to stay constant over the time. Discount bond currently is selling at a price lower than the par value, but at its maturity, it will go up to its par value. So if we hold the yield to maturity constant, over the time, the discount bond price will increase. This is an important property of the bond. If we hold the yield to maturity constant over the time, premium bond price will decrease, par bond price will stay constant, discount bond price will go up. Now, let's introduce some new concepts. Current yield and the capital gains yield. Current yield is defined as the annual coupon payment divided by the current price. Capital gains yield is defined as the change in price divided by the beginning price of the bond. The expected total return from the bond, which is also the yield to maturity, is the sum of these two yields. So yield to maturity must equal the sum of the expected capital gains yield and the expected current yield. Let's look at our example. Let's say we have a 10-year maturity bond with 8% annual coupon rate, yield to maturity being 10%, par value is 1,000. What is the current yield? Well, this example, we have seen that early. So the price of this bond has to be $877.11. With 8% annual coupon and the $1,000 par value, its annual coupon payment must be $80. So 80 divided by $877.11, that gives us 9.121%. Let's also calculate the capital gains yield of the same bond. Well, to calculate the capital gains yield, we have to find out the price of the bond 1 year from now. So 1 year from now, the bond has 9 years left till its maturity. So the bond price 1 year from now, at the end of year 1, we can use the Excel spreadsheet. That will be equal sign, PV stands for present value, 0.1, 10% means the yield to maturity. 9 means the maturity. 80 means the coupon payment. 1,000, which is the future value. That should give us the price of the bond 1 year from now, which is $884.82. Now, the capital gains yield will be the year one's price, $884.82, minus the current price, $877.11, divided by the current price, $877.11. That should give us 0.879%. Now, the yield to maturity, sum up the capital gains yield and the current yield, 9.121% plus 0.879%. That'll be exactly the yield to maturity, which is 10%. Now, let's look at the price and yield to maturity relationship of a bond. Let's use one example. A 10-year maturity, 10% annual coupon rate, yield to maturity is 10%, par value is 1,000. What should be the price? Well, when you look at the 10% annual coupon rate and the 10% yield to maturity, you know this is a par bond. So we don't really have to use the Excel spreadsheet to calculate the price. We know this is a par bond, then the price will have to be the same as its par value, so 1,000. Now, let's say the Federal Reserve lowers the interest rate. The yield to maturity becomes 6% for this bond. What is the price of the bond? Well, now we have to use the Excel spreadsheet. Equal sign, PV stands for present value, and then 6% as the yield to maturity, comma, 10 as the maturity, comma, 100 as the coupon payment, comma, 1,000 as the par value. Calculate the bond price, $1,294.40. Now, let's say the Federal Reserve wants to further lower the interest rate to 3%. So they started a quantitative easing, which we'll explain that later. So let's say the yield to maturity becomes 3% now. What is the price of the bond? Use the Excel spreadsheet, equal sign, PV, 3%, comma, 10-year maturity, comma, 100 coupon payment, 1,000 par value. Calculate the price, $1,597.11. Now, from these calculations, we can generalize the price and the yield to maturity relationship of a bond. When the yield to maturity goes down, what will happen to the price? The price will go up. And vice versa, when the yield to maturity increases, the price will have to decrease. So the bond price and its yield to maturity are always inversely related. And this yield to maturity and the price relationship can help us explain what the Federal Reserve did to save the economy from further recession in the 2008-2009. So in 2008, when the financial crisis happened, the Federal Reserve cut the benchmark interest rate to almost 0%. But they want to do something more to help stimulate the economy by further lowering the interest rate. Well, how did they do it? Well, they printed $80 billion worth of money a month and poured that money into the 10-year Treasury securities market. The 10-year Treasury security is issued by the Department of Treasury. So when there's $80 billion more in the market buying up the securities, that will drive up the price of the 10-year Treasury. And because the price and yield to maturity are inversely related, when the price goes up, the yield to maturity goes down. And the 10-year Treasury securities yield to maturity is a benchmark rate of a lot of other interest rate in the economy. So when the price of the 10-year Treasury is up, driven by the actual money that the Federal Reserve printed, then the 10-year Treasury's yield to maturity is artificially lowered. So all the interest rate in the economy follow the 10-year Treasury securities yield to maturity. and all the interest rates are kept at the lower level. That's why the Federal Reserve wants to do the quantitative easing, and that's what a quantitative easing means. Basically, the Federal Reserve printed money, use that to buy the 10-year Treasury securities to keep the interest rate low so that the business and the individuals will find their borrowing cost is low, and that will stimulate the economy. Now, we already know the price and the yield to maturity of the bond are inversely related. Now, what will determine this relationship? Actually, there are two determinants of this relationship: maturity of the bond and also the coupon rate of the bond. Let's look at the following example. In this table, we have two bonds. A 10-year maturity bond with 10% annual coupon rate and par value 1,000. The second bond has 20-year maturity and 10% annual coupon rate and par value also 1,000. Now, the only difference between these two bonds, the first one has 10-year maturity, the second one has 20-year maturity. Now, let's say at the beginning, the yield to maturity for both bonds are 10%. So that's the middle row of this table. When the yield to maturity is 10%, same as the coupon rate, we know we don't have to use the Excel spreadsheet to calculate the bond price because both bonds will have to be par bonds. Both bonds price will be 1,000. But if you want to use the Excel spreadsheet, they will turn out to be $1,000 as well. Now, let's say for some reason yield to maturity decreases from 10% to 6%. What will happen to the bond price? The 10-year maturity 10% coupon rate bond, let's calculate its price. So equal sign PV 6% as yield to maturity, 10 as the maturity, 100 as the coupon payment, 1,000 as the par bond, a par value. The price of the bond will be $1,294.40. For the 20-year bond, same thing. Equal sign PV, 6% yield to maturity, 20 as maturity, 100 coupon payment, 1,000 par value. The bond price will be $1,458.80. Now, when the bond yield to maturity decreases from 10% to 6%, both bond price will go up. And this is consistent with the bond price and yield to maturity relationship because they're always inversely related. When yield to maturity decrease, price increase. Now, which one increased more? The 10-year maturity bond increased from $1,000 to $1,294.40. The 20-year maturity bond increased from $1,000 to $1,458.80. So apparently, it's the 20-year bond that price will increase more. Now, when the yield to maturity increased, what happened to the bond price? Well, according to the price and yield to maturity relationship, we can guess that the price will go down. The 10-year bond, the price will be $749.06. And the 20-year bond, the price will be $687.03. Now, both bond price will go down when the yield to maturity goes up. Which one goes down more? It is the 20-year maturity bond. Again, that price will change more from $1,000 to $687. The 10-year bond changes only to $749.06. So it is the 20-year maturity bond, that price change is more when the yield to maturity changes. And to generalize, the longer the maturity, the more sensitive the bond price change is when the yield to maturity changes. Now, the second determinant of this bond yield to maturity relationship is the coupon rate. Let's look at the following example. We have two bonds again, 10-year maturity, 10% coupon rate, par value 1,000 versus a 10-year maturity, 15% coupon rate and par value 1,000. Now, the only difference between these two bonds is the coupon rate. One has 10% coupon rate, the other has 15% coupon rate. Again, let's say the yield to maturity at the beginning is 10% for both bonds. Now, for the 10% coupon rate bond, it's a par bond because the yield to maturity equals the coupon rate. So this bond price will be 1,000. For the 15% coupon rate bond, we will have to calculate its price. Use the Excel spreadsheet, equal sign PV, 10%, 10-year maturity, $150 coupon payments, which is 15% coupon rate times $1,000 par value. Then $1,000 par value, close the parenthesis, calculate the price, $1,307.23. Now, when the yield to maturity decreases to 6%, what is the price of the bond? For the 10% coupon rate bond, the price will be $1,294.40. So when the yield to maturity decreased from 10% to 6%, the bond price of the 10% coupon rate increased from $1,000 to $1,294.40. That's a 29.44% increase. How do I get this 29.44%? It's the ending price, $1,294.40, minus the beginning price, 1,000, divided by the beginning price, 1,000. So that's a 29.44% increase. For the 15% coupon rate bond, the price will be $1,662.41. So the percentage increase of this bond is 27.1% price increase. Now, when the yield to maturity increase to 15%, what will happen to the bond price? For the 10% coupon bond, the price will be $749.06. That's a 25.09% decrease. And for the 15% coupon bonds, the bond price is 1,000 because it is par bond now. And the coupon rate equals the yield to maturity. And this will be a 23.5% price decrease. Now, let's look at the price changes in terms of percentage. When the yield changes, which one's price changes in greater degree in terms of its percentage change? Apparently, it's the bond with the lower coupon rate. So to generalize, the lower the coupon rate, the more sensitive the bond price change is when the yield to maturity changes. And actually, we can combine this with the previous property. So the longer the maturity, the lower the coupon rate, the more sensitive the bond price change is when the yield to maturity changes. Our next topic to cover is the yield to call versus yield to maturity. Early on, we mentioned that most of the corporate bonds nowadays are callable. Callable means after a few years, the bond was issued, the bond can be called by the issuer of the bond, which means the issuer of the bond can buy back the bond. Now, the next examples will illustrate when the bond will get called and what the bond investors should expect when they invest in the bonds. Let's look at the following example. Let's say we have a 10-year maturity bond with 10% coupon rate. Par value is 1,000. Now the current price of the bond is $1,100. What is the yield to maturity of the bond? Well, we can use the Excel spreadsheet to calculate the yield to maturity. And there's a built-in function in the Excel spreadsheet to calculate this. So the yield to maturity is equal sign RATE, rate. That's the built-in function to calculate the yield to maturity. In the parentheses, 10 is the first parameter, which is the maturity, comma, 100 is the coupon payments, which is the 10% coupon rate times the $1,000 par value. That gives us $100 coupon payments, comma, 1,100, which is the current price, and that has to be a negative value because it's a cash outflow. So negative 1,100, comma, positive 1,000, that's the par value. Close the parenthesis, press the enter key, we will get the yield to maturity of the bond is 8.48%. So if we hold the bond to its maturity, this will be the return we can expect to earn from the bond every year. Now, if the bond is callable 3 years after it was issued, at a call premium $1,050, then what is the yield to call? So if the bond gets called, what is the return that we can expect to earn from the bond? Now, let's calculate this in the Excel spreadsheet. Equal sign, rate, which is the built-in function. In the parentheses, 3 is the maturity because when you call the bond's maturity is only 3 years long. Comma, 100 is the coupon payment, comma, 1,100 negative, which is the present value of the bond, the current price of the bond, and because it's a cash outflow, it needs to be negative, comma, and then the call-in price, which is the call premium, $1,050, and then close the parenthesis, we get a 7.69%. Now, put you in the shoes of the issuer of the bond. If you don't call the bond, let the bond go to its maturity, you'll be paying the yield to maturity to the bondholders, and that yield to maturity is 8.48% a year. Or you can call the bond 3 years after it was issued, then you'll be paying 7.69% to the investor of the bond. So if you are the issuer, would you call the bond? Of course you will, because if you call the bond, you'll be paying a lower interest rate at 7.69% instead of 8.48%. So you will call the bond. Now, a lot of people might ask, what happens if I call the bond? I still need money to finance my project. Well, you can issue some new bonds with a lower interest rate. And then that way, you only paid 7.69% on the bond that you originally issued, but now you can pay a lower interest rate to issue some additional bonds and keep up the financing of your project. Okay, so as the investor of the bond, when you buy the bond at $1,100, you would expect to earn only yield to call instead of yield to maturity because you know the bond will get called. So to generalize, when the bond is selling at a premium price, and typically this happens when the coupon rate is higher than the yield to maturity, and the bond will get called. So the investor of the bond should expect to earn yield to call. When the bond is selling at a par or discount price, this is happening when the bond coupon rate is lower than the yield to maturity, then the investor should expect to earn yield to maturity because the bond will not get called. In this chapter, we study the key features of the bond. We studied the bond valuation, and then we learned about the properties of the bond, the price and yield to maturity relationship, and the determinants of these relationships. And then lastly, we study the yield to call when the bond is callable, and under what circumstances the investor should expect to earn a yield to call versus a yield to maturity. Thank you.